Imagine your New Zealand rental loses money, but the UK still slaps you with a £2,600 tax bill. Sounds wild, but it's true. If you're a Kiwi living in the UK with a property back home, get ready, because your humble Christchurch flat might be sneakier than you thought. Most conversations start like this: I pay tax in NZ, so I'm sweet. Or, my rental doesn't make a profit, so nothing to declare, right? Wrong. In the eyes of HMRC, your worldwide income is fair game. Even that little house on a hill in Dunedin you haven't seen since Jacinda was Prime Minister. And New Zealand still wants their cut too, because the property's sitting on their dirt. 2 tax agencies, 1 rental, and 0 room for error. Now, before you start hyperventilating into your all-black scarf, let's break this down. Here's how the tax tug-of-war actually works. NZ taxes the rent because the property's there. The UK taxes the rent because you are there. And a double tax agreement tries to stop you from being robbed twice. But only if you file correctly in both countries and claim relief the right way. And that's where most people faceplant. Let's take Terry. Terry's a higher rate taxpayer living in London, but his heart and mortgage are still in Christchurch. His rental, cash flow negative. Mortgage interest chews through the rental income. So, NZ tax? 0. So he's in the clear, right? Cue evil laughter from HMRC. In the UK, Terry can't deduct mortgage interest. He does, however, get a 20% credit instead of a deduction. This means that while it is the same cash in, same cash out, suddenly his UK taxable profit is £13,000. This means he faces a tax bill of £2,603, despite not making a cent in NZ. This is not a glitch, it's just how HMRC rolls. And that's just the beginning of this Kiwi tax maze. Depreciation? In NZ, you can claim it on chattels like appliances, furniture, and carpets. In the UK, forget it. You can't depreciate anything, not even the furniture. HMRC only gives you relief when you replace something that was already there. Like for like. Old washing machine out, new washing machine in. That's fine. But installing a washing machine for the first time? That's an improvement, not a replacement. HMRC says, thanks for the upgrade, but no deduction for you. Oh, and before you even think about buying a house in the UK while still holding onto that Kiwi rental, brace yourself. Stamp duty land tax once in. If it's an additional property, add a 3% surcharge. If you haven't lived in the UK for 183 days before completion, hello, another 2% surcharge. Suddenly, that £500,000 London flat costs you £40,000 in stamp duty alone. Hope you weren't saving for new furniture. But wait, it gets better. Even if you can reclaim those surcharges, you'll need to prove your NZ property was your main home. Sell it within 3 years. And provide a paper trail that would make the Inland Revenue weep with joy. Mess up a single detail? No refund, no mercy. Bottom line? No profit doesn't mean no tax, and already paid in NZ doesn't mean job done. The UK and NZ systems speak different dialects of Accountanese, and you're the one stuck translating, in pen, under oath, with penalties on the line. So if you're a Kiwi landlord living under Big Ben's watchful eye, file in both countries, claim the credits, get the math right. Because when it comes to HMRC, you don't need to make a profit to owe the taxman.